I'm joined now by Shawn Hoyer with Bank of America. Shawn, how are you doing today?
Good. How are you, Austin? Good to be with you.
I'm doing great. It's great to connect with you virtually. You are an expert in this topic. Why don't you tell us a little bit about what you do with Bank of America, but also just kind of your background?
Most of my 22 years in banking has been working with private companies, entrepreneurial-backed companies, throughout different capacities, whether it's been lending to private companies, raising capital for private companies. But the last 4 years, I've now been sitting in the position within the investment bank at Bank of America, leading our venture capital coverage practice. So what does that mean? Venture capital, as we know, has become a very significant force in private capital raising. Most of the companies that are going public today are currently venture-backed. These are investors that have been investing for 5-10 years in these types of companies are now seeing the rewards. And then certainly the onslaught of private capital has made venture capital even more pronounced, as more and more of these what were perceived to be venture companies are now becoming very large. And so my investor base are the top 25, top 50 venture capital firms in the world, consisting of the Sequoia Capitals, the Excels, the Bessemer Ventures, folks like that. My primary function with those investors is their portfolio companies. I do sit within the investment bank, so it tends to be transaction driven, either IPOs or raising private capital rounds. Usually those larger last private rounds before a company looks to go public or sell. And it's a global practice, so I work with investors all over the world in venture. A large predominance, a small number of venture capital firms carry a significant weight of the overall economics in overall returns. But I also have good connectivity with seed investors in Latin America, Europe, something that certainly borders are continuing to break down.
As far as trends go in VC right now, we touch on a little bit of the things you're seeing there now, but I'd be curious if there's maybe one or two standout things in VC as a whole at this point in time that really stands out to you as a trend.
Capital it used to be a San Francisco story, right? A West Coast story or an East Coast story. It wasn't something that you found in Europe, in Latin America, in Asia, right? Countries all over the world. It was if you were going to raise meaningful capital, you were probably going to have to move your company to San Francisco, right? To the US, if you happen to be a European company. So I think that's one thing that has changed, right? We all know how rapidly valuations have increased in the United States, especially in areas like San Francisco, New York, that what capital providers are realizing, because now we're somewhere around over 4 trillion in private capital today that is looking to be put to work, right? That's a lot of money. And only so much of it, if you are a fund looking to return capital to your limited partners, to your investors, it's getting harder and harder to make those returns given the way valuations have crept up. And so what you've seen is most venture firms are shifting out of the United States to move their focus to where they can get better returns on these types of deals in places like Europe, whether it be places like Australia, Latin America, certainly Asia has been its own isolated story. So the borders have really come down, right? You no longer as an entrepreneur have to feel that you've got to pick up your company, and if you're going to get the right talent, right, certainly work from home. The ability to have far-flung teams has improved dramatically with the support of technology. So now that's probably one of the biggest trends, is that if you're a good company, capital will find you. And it's gotten so competitive in the capital landscape that there are teams and teams of analysts at these firms trying to make sure they uncover every interesting company around the world. So I'd say that's the first trend. I think another interesting trend that I think is up for debate, and certainly among my client base, which is so much capital has now gone into investing in growth companies, right? Private technology companies. all of the returns, the predominance of returns coming in the public markets are from software companies, from consumer internet companies, right? All that most of my investors have invested in the past 10 years. There's an argument to be made that investing in a software company 10 years ago, very risky. Very unsure about the pathway to figure out, will this company be successful? What are the metrics? What's the go-to-market motion for a software company? A lot of that has been figured out. Yet the returns have been so strong in software, we're now at this interesting dilemma where venture capital continues to double down on things like software because that's where the returns have been. The challenge is, as that gets de-risked, you would expect capital to become cheaper, for lack of a better term, or more competitive, right? And so what you're now seeing, you're seeing large asset managers, hedge funds, private equity funds that have many billions of dollars, where if a venture firm has a $5 billion under management, that's a very meaningful venture capital firm. Now you've got big money where $5 billion may be a rounding error, that are saying these investments, investing in software, investing in internet companies, has become de-risked. So we're willing, because we're a lower risk investor, we now view this as a lower risk. And so the debate I think that's happening in the venture world is, are you going to see big funds get bigger to write bigger checks because the margins are getting smaller, so the way they're going to provide returns to their investors is investing big checks into big deals and doing it strictly with deal size, right? Check size. Or are you going to get venture capitalists going back to what venture capitalists used to do, which was they were the only people willing to invest in a given sector or a given technology, right? You've seen the pull forward of frontier tech, whether it's autonomous driving, new energy sources, food alternatives, right? That still have a lot to prove. Maybe that is the area that venture capitalists who are truly looking for returns go back to and start writing those kind of checks. I think you're going to see probably a bifurcation in the venture world where you're going to have large funds that will lose the word venture altogether because they're going to do everything from investing in venture stage companies to late stage companies. And then you'll probably have a very small group of investors that are focused only on investing in early stage companies, right? So I think that's one of the bigger trends. And part of it is just, you're just continuing to see more and more pressure of private capital coming from all angles, right? Family offices used to write a few $1 million. Today they're writing a few $100 million into deals. So it's a very competitive landscape right now, which is ultimately good for entrepreneurs.
And I wanted to touch on Kansas City specifically a little bit now, but just to kind of give you a little bit of insight from what we've seen here on our end, and then to pick your brain a little bit here. We're seeing obviously, sizable rounds still coming through with those out-of-state investors. We've been seeing sort of an uptick in exits, it feels like, maybe even some startups exiting a little bit earlier than you might have anticipated. But we're also still seeing people leaving the area in search of capital. What would be your experience, or what is your experience kind of with VC here in Kansas City, and are you seeing any of those things, or kind of what is your perspective there?
When the pandemic first started, right, everybody said, I don't know if we're going to be able to make an investment in a company that we've never met. Now investors are doing a lot virtually, right? We expect that to continue. Private equity there have been private equity firms I've worked with that used to say, if it doesn't take me at least 2 flights to get to a company, it's probably not the right deal. It's probably a deal that's everybody's seen. So I think venture is adapting to that idea that they can effectively be of benefit to an entrepreneur in building a company, that they don't necessarily have to be in the backyard, right? So I suspect that will continue to change. I think what you are seeing, and I think a lot of these patterns are going to stick, which is, if I'm a computer engineer and I've always wanted to work for one of these cool startup companies, but I just don't want to live in San Francisco, right? I don't want to pick up and move to Austin because I was born and raised in Kansas City. That's where I'd like to stay. No longer are you relegated to, well, I guess you're not going to be able to work for one of those companies, but more importantly, your ability to start a company and get capital attracted. I think more and more venture investors are looking for those opportunities of, And I think what you ultimately see too, you see better company behavior when you're not in San Francisco, right? You get people who have started companies with the idea of creating a going concern, creating a company that will make money, a company that actually stands the test of time, versus the Bay Area model of go big or go home. We don't care what you have to spend to grow top line. I think that's a challenged model as well, where people are saying, if you can find me a $10 million, a $5 million software company in a city like Kansas, in a city like Kansas City, that has been capital efficient, hasn't raised a tremendous amount of outside capital, that becomes really compelling for investors to get in early into these types of names, where they can see the opportunity and they say, we can help expand the revenue opportunities for this business because of our connections, and so we can turn this into a $50 million company. We can turn it into a $100 million company, but the benefit is we were able to get in when not 15, 20 other investors were in front of the business before we were. So I think that all of these cities, you're going to see this rise. I mean, I think it plays into Revolution's thesis and Steve Case's thesis around rise of the rest, that no longer can I only get the best technical talent in San Francisco. Actually, now there's a lot of people moving out of San Francisco who are moving to other smaller cities because they want that lifestyle adjustment. And so now talent is proliferating to every corner and every state, and you're seeing that in the numbers, that venture capital investment continues to increase at the regional level, and you're seeing it being pulled away from Boston, New York, and San Francisco. Now, the benefit is total dollars raised have continued to be massive. So those areas aren't seeing a dip in capital, but what's really positive is you're seeing regions throughout the United States continue to get more and more incremental venture capital invested in their cities and states.
And as far as the companies here in Kansas City go, do you hear any buzz about any particular startups in your part of the world and in the conversations that you're having?
I've been fortunate to be in the Kansas City area and get a chance to meet a couple of companies, and Shot Tracker, I think, is a really neat technology. I said I'm a sports guy. I think you're seeing again, right, this ability for a company to really have meaningful investors, meaningful support, but also a technology that is really, really interesting to a lot of people that, again, happens to be based in Kansas City, right? Somebody like a Replica, somebody like a Torch.ai. That's a good example of a company that I don't think people know really exists yet, right? And it's been a company that's operated below the radar in a very interesting space when you look at some of the companies that have gone public, like Palantir, C3.ai, right? These entities that have gotten a lot of attention. And when you find a company that has good scale and good growth, but also very capital efficient, those are very interesting stories. And so my investors probably get the most excited when I reach out to them and tell them about a company that I've met in Buffalo, in Kansas City, right? In Plano, Texas, that they just didn't know were there because they wouldn't suspect there would be that type of company there traditionally.
And I want to talk a little bit about our local firms here in Kansas City. So I have this statistic here from our last year's VC-backed companies report, which was in 2020, 23% of funding, VC funding, came from Kansas City area investors. Now, when you hear that number, as far as local support for startups goes, is that a good number, or should we be aiming for that to be a little bit higher?
Anything in venture, right, in life in general, but success begets success, right? I mean, part of the reason that there's been such a rise of capital, and it stays that way between San Francisco, New York, and Boston, is because there's been success in San Francisco, New York, and Boston. That liquidity gets generated, and it gets reinvested into the next startup. The CEO that made $100 million decides to stay in that area. She starts a new company, and she raises additional capital, and that gets reinvested in the entrepreneurial economy. I think what you're now starting to see in a lot of these cities is you're seeing these operator-led rolling angel funds where you get a group of successful business people that have created companies. Maybe they haven't sold them, but they've got good companies that they've created, right? They're collectively among 6 of these entrepreneurs. They decide, you know what? We're entrepreneurs. We've built companies. We know how to run a company. Why aren't we investing? And I find in a lot of these cities, it's entrepreneurs that have created a lot of value in these cities want to invest in other entrepreneurs in those cities. So ideally, do you want to see more successful business people? And I'm not talking about just tech, right? I'm talking about any industry that might be in a city that these leaders come together and create these rolling angel funds that provide a lot of that initial seed capital to really kind of invigorate the entrepreneurial economy. I think you're starting to see that more, certainly in cities like San Francisco and New York. But I think every city probably is starting to see that building of those networks, because I think that group of investors, as the venture world, the traditional venture world, because of the pressure that we talked about on the front end about more capital chasing fewer deals, right? Their checks and their entry points are getting later. So I think the rolling angel funds will play a much greater role in building out the ecosystem in a given city or a given market, because the venture capital guys will want to write bigger checks and later. So I think those rolling angel funds, you want to see that number increase, because I think it'll just be a meaningful underpinning for creating that type of environment. Then the other thing that I'll say too is that, you know, it takes a mindset shift. It's kind of a chicken or the egg discussion when you have, we've seen this, if you look at Israel, right? 10 years ago, most Israeli founders would typically sell their business, right? I mean, if you live in Tel Aviv and somebody offers you $100 million for your company, you're kind of like, you know what, that's a great outcome, I'll be comfortable, thank you. But now when you go into Israel, the idea of selling your business for $100 million, no, I believe this can be a multi-billion-dollar company. And as a result of that mindset, now part of it is, well, there's more capital flowing in, so entrepreneurs are realizing they can get the capital to take this business to the next level. But I think as more capital finds its way, more people start to realize that, you know what, I could sell my business. I could, but I actually choose not to, because I think there's a lot more value to create here. And I think you're seeing a lot more interest from entrepreneurs in their own cities, right? UiPath would be a good example. One of the largest IPOs ever. We were involved in that IPO. It's a Romanian-based company, and it's worth $30+ billion today. The idea that 7 years ago you would have told me there would have been a $35 billion company based in Romania, I would have said you're crazy. And more importantly, Daniel Dines, the founder and CEO, specifically didn't want to move his business to the United States. Yes, he has operations in the United States, but it was very important to him about the overall economy and building up of the country of Romania. And so that I think founders also have that piece to them that says a lot about where they're from.
And in our final few minutes together, I want to talk a little bit about IPOs, because of those companies who are, as I mentioned before, we've had companies who have exited, but also those companies that you're talking about there, who are maybe holding out a little bit longer. What would you tell them to prepare them in this particular state of our world to prepare for an IPO, if that's something they're looking to do?
The first thing I would say is be careful what you wish for. Being a public company is being a public company, and I think oftentimes people view that as some sort of a finish line, when that is just yes, it's creating liquidity, but today, again, given private capital that's out there, there are a lot of options, right? When we would sit down with an entrepreneur and we would talk to them about strategic options for their business, you used to say there's an IPO and then you could sell the business. Today, there's probably at least five different alternatives a company can be thinking about. Maybe we'll stay private and we'll raise $100 million. Even if we're at scale and we don't need the money, maybe we decide to raise $500 million that allows us to continue to create a more mature company to be ready to be public, right? You have this whole SPAC phenomenon, the special purpose acquisition corporations that are out there that are creating a different type of avenue for companies to be public. You do have the option to build out a fulsome M&A strategy, right? Potential sell to a strategic or a potential strategic investment in the company that allows you to maintain control in your destiny. So no longer is IPO the only option an entrepreneur should be thinking about. First and foremost, they should always be figuring out, am I ready to be a public company? I think we're starting to see that in the SPAC environment, that a lot of companies who became public through a SPAC maybe perhaps weren't ready to be a public company. And that can be, I think, a challenge for a lot of these entrepreneurs. So it's size. There is still a size and scale that a company should be to be a public company. So usually at around 75 million in revenue, 100 million in revenue, now you're getting to that size where you can start thinking about those types of opportunities. But the bottom line has never changed. Great companies have a lot of options. They can go public in bad times, in good markets, bad markets, right? If it's a good company, you've got tremendous options out in front of you. And the good news today, being an entrepreneur, you can't pick a better environment today because, again, there's just so much capital chasing fewer deals. More capital wants to be put to work. And it's not just coming from the venture world, right? It used to be if you were going to raise $5 to $40 million in capital, you were going to talk to a venture capital firm. Today, you can talk to a hedge fund, you can talk to an asset manager, you can talk to an insurance fund, you can talk to a family office, you can talk to a traditional private equity fund that has a growth venture sleeve, or you can talk to venture investors, or you can talk to successful entrepreneurs. We're now seeing that there are entrepreneurs that have had big exits from their companies, and they're not a VC firm. They're an individual investor, but they're writing $50, $75, $100 million checks personally, right? So that dynamic, what we always encourage, if a company decides to look at raising private capital, think about who you want sitting next to you in the boardroom and why are they there? Are they there just because of capital? Are they there because you want them to open up new revenue streams? Are they there because you need some sort of operational expertise, right? That, I think, is the bigger challenge for entrepreneurs to decipher and think about is, wow, this is great. I can raise capital because there's a lot of capital out there, but it has very different forms. So just the way you should think about, am I ready to be a public company? If you're staying private, continuing to raise capital, you should be thinking about, who do I want sitting next to me in the boardroom, and what value are they bringing outside of just quantum of capital?
And lastly, for those founders watching today who are maybe in that angel phase, they're running on angel investments, they've got friends and family, they're starting to look towards that first venture round. What is your biggest piece of advice for those people as they look to take on that first initial injection of capital?
I think for me, it's understanding the addressable market that you are going after, understanding the competitors in that market, but having a really good product. Similarly, great companies can do great things. You could probably take that down a layer. Great products that are built by companies give them a lot of flexibility. And more, I think investors want to dive into the strength of the product, right? Because if you can find one customer to buy a product, two customers to buy a product, what's really meaningful when you have multiple customers saying, I love this product so much, when they come out with another product, I'm absolutely going to buy it, right? Like, that's the technology speaking for itself. That's the product speaking for itself. So make sure you've got a really, really good product, right? Because all of the other stuff, right, telling the story and how you're going to change the world, at the end of the day, it's going to come down to the IP that is created and controlled by that founder. And investors at the early stage are going to want to talk to the creator of the technology, the creator of the product, and really be able to go deep and have a defensible story around why this product is better than what's out there. Who are you selling to and who are you taking business from, right? That understanding everything around that product I think is really important. So I would say at the early stage, product first, right? Again, if you have a great product, capital will find you. You will have plenty of opportunity to raise capital if you've got a great product. If no one's interested, you might have a more challenging product.
Well, Shawn, thank you so much for joining us today. I really appreciate you taking the time for this conversation because I do believe it will help a lot of people here in Kansas City who are looking to kind of get to that next level as far as funding goes, but also those people still navigating those various rounds and looking to get to that place of exit. So we appreciate you being here. We appreciate Bank of America's support as well of Kansas City's ecosystem, but also of this conversation today.
Really appreciate it, Austin. Thank you.